Hello, and welcome to Fitch's next installment of its virtual investor series. I'm Grant Bailey of the Global Structured Finance team, and with me today is Alessandro Picchi, who heads up EMEA RMBS, and Rachel Noonan, a senior director in our US RMBS team, who will both be giving a quick update on their respective RMBS markets today. Rachel, I'll start with you. What notable trends and developments are you seeing in new issuance activity in the US?
Thanks, Grant. So yeah, we have seen issuance in the US RMBS market, at a pretty steady increase for the past couple of years, and that's been no different for 2020 and 2021. We did see a little bit of a lull last year in 2020, really due to the uncertainty of the pandemic, but the second half of last year and into this year, again, it's been growing pretty significantly. A couple trends we've been seeing is an uptick in prime jumbo. We've seen a lot more issuance in this space. In particular, the deals have been larger in size. We've seen even stronger collateral than we've seen in the past, higher FICOs, lower LTV profiles. We're seeing more issuers come into the market, more aggregators, and even more originators. We're seeing more names out there that we hadn't seen before. Earlier this year, we also rated the first post-crisis transaction backed by new origination manufactured housing. So I think that's a space that has some, growth potential. A few other trends that we've been seeing bonds issued based off of SOFR as a result of the phase out of LIBOR. A big topic is the increase in property inspection waivers. We're seeing more and more originators opting into the appraisal waiver programs. We've seen a rise in investor properties, including investor cash flow loans, which are originated with the DSCR. This is really a direct reflection of the GSE cap that was put both on investor and second home properties. We're seeing continued growth here, and we're even expecting to see transactions comprised of 100% investor and second home properties. And just thinking ahead, there are a few sectors where Fitch is not currently involved, but I do expect us to see continued growth. These include warehouse facilities, revolvers, and FHA early buyout loans. And like I said, while we're not currently rating these, we are thinking about them and what our possible analytical approach to these will be.
And Alessandro, what about you in Europe? What notable trends and developments are you seeing with regards to new issuance activity there?
Talking about rating participation in EMEA, I think the overarching theme is one whereby non-bank lenders are effectively taking over. And if you think about a few years ago, both by volumes and numbers, the number of securitizations issued by banks was dominant, whereas now by number of trades, really we're talking about a 50-50 market. So non-bank lenders in EMEA RMBS are present in UK buy-to-let and Dutch buy-to-let, in Dutch prime. They are backing portfolio acquisitions of vintage UK non-conforming transactions and also sponsoring specialized lenders in the UK prime space. In this securitization, we see a lot more complexity. So liability structures are way more complex, and also the rating participation is a bit more varied compared to the standalone prime RMBS that we've seen in the past. Another interesting development in EMEA is the focus on green and social aspects. So in the UK, we've seen some social bonds being issued that are used to finance eligible social projects, namely access to credit for weaker borrowers. While the growth of green mortgage for us could be a material for criteria development, and we could develop bespoke assumptions if the correlation between energy efficiency and overall mortgage performance is validated. For the social aspects, this is a bit more tricky for us, because if you think about these are portfolios backed by the riskier borrowers or the weaker borrowers, those are typically the portfolios that are attracting higher credit enhancement. So that's an interesting trend that we expect to see in especially in the UK, but in EMEA overall.
Thanks, Ali. So it's just sticking with you and moving from new issuance activity to surveillance, which RMBS asset classes in Europe remain under negative pressure from the pandemic, and what's our rating outlook for those areas?
Yes, Grant, as you say, the negative pressure has eased, because in most countries, the economic recovery that has been there since Q1 this year and the sustained support schemes that the various governments have put together is still a strong support for these markets. So we have stable outlooks for most countries in Europe, with the exception of UK non-conforming and Portuguese RMBS. For UK non-conforming, the situation is one whereby the weaker profile of borrowers, as always in the past, encountered performance hiccups as soon as the economic background deteriorates. So there's not really a novelty there. It was expected. For Portuguese RMBS, the reason for negative outlook is perhaps a bit more technical. So we have the rating count is low. So it suffices that few tranches are on negative outlook for the sector to be labeled negative on negative outlook. But overall, I don't think Portugal is riskier than other Southern European markets as things stand.
Thanks, Alessandro. And Rachel, moving to the U.S., which RMBS asset classes in the U.S. remain under negative pressure, and what's our rating outlook there?
Yeah, sure. So I think it's a similar story here in the US. A number of bonds that we had on rating watch negative or rating outlook negative has come down substantially since the period immediately following the peak of the pandemic last year. We did see that a lot of the negative pressure was concentrated in the post-crisis vintages. This is mainly due to the fact that the legacy deals often had other rating caps on them, which was constraining the buildup of positive pressure. Most of these have been resolved with affirmations. A small portion have actually seen downgrades. Something we're continuing to watch is delinquencies. They have moderated a bit, but they are still elevated when comparing them to early 2020. So again, something we're going to keep an eye on. And looking at where we are now, the largest area of bonds that remain on rating watch negative and rating outlook negative is in the new origination post-crisis transactions. But it is expected many of these to be resolved in the second half of 2021.
Got it. Thanks, Rachel. And just sticking with you in the U.S., what specific risks do you think RMBS investors should be focused on as the economy continues to recover into the second half of this year and into next year?
Yeah, that's a great question. I think one of the biggest issues here is just figuring out what is going to happen if and when the COVID relief that has been granted over the last year comes to an end. So if borrowers are no longer receiving stimulus checks, could that have an impact on a borrower's ability to make their payments? While we've seen the number of new borrowers entering into forbearance or deferral plans drop significantly, there are still a number of borrowers on active forbearance plans. We're also expecting foreclosure moratoriums to get lifted. So this may cause an increase in modification activity, which could result in more RPL loans on portfolio. Another big topic is always home prices. We saw home prices grow significantly in 2020, the highest annual growth we've actually seen since 2014. And the question is, how long will this be sustainable? As of the first quarter, we estimate that national home prices are about 8% overvalued, and that's up from about 5.5% the prior quarter. Fitch estimates prices in approximately 35% of the MSAs in the country are overvalued by more than 10%. This is due largely to favorable mortgage rates and a big imbalance in supply and demand, which caused home prices to accelerate over the last year. We saw a big shift from cities to suburbs with expanded remote working, people's desire for larger spaces at reduced costs. We've seen renters move away, especially from some of the more expensive cities, San Francisco, New York. And we will expect this bifurcation, between urban and suburban to continue. We expect the rental market to recover to some degree, but likely not return to pre-COVID levels for a while. And this is important because the rental price index is one of the most influential variables factored into our sustainable home price model. And lastly, I think the other thing that we're going to be keeping an eye out for is the new QM rule. I think there's still a lot of uncertainty around it. We haven't rated any transactions with loans originated to the new QM rule, but it sounds like a lot of originators are starting to originate loans under this. And I think it's something we're going to start to see, but I do think it's something that's going to need a bit more clarity.
Thanks, Rachel. And Alessandro, in Europe, turning to you, what specific risks do you feel European RMBS investors should be focused on as the economy recovers into next year?
Yes, thanks, Grant. So I think what we are monitoring closely is the late arrears in again UK non-conforming, because they have been rising since the onset of the pandemic. So they're now around 8% as an index. They were 6% at the beginning of 2020. And also the sector has recorded a higher take-up of payment holiday. So the claims still in payment holiday are higher than 5% against an average for prime and buy-to-let, which is between 1% and 2%. So we expect that some of these borrowers will currently in payment holiday will roll into arrears. So the late arrears will grow even further. From a rating perspective, we've tested the portfolio with our additional coronavirus assumption, and they proved by and large resilient. There has been few limited downgrades, but the asset outlook on the sector remains negative. The second factor that I would zoom in is still related to the labor market in Europe. And if we zoom in countries where the labor participation in sectors such as transport and leisure is higher than average, we expect that our economists expect that an unemployment uptick for the rest of the year, which is probably higher than average. So we are asking ourselves whether in these sectors with flexible working arrangements and perhaps less protection for the workforce, the exposure to self-employment, but more generally the exposure to tenancy risk for buy-to-let portfolio is something that could potentially be a risk to watch. And to what Rachel was saying before, we are also experiencing and seeing some softening of rental markets, especially in the UK, in some of the core markets pre-COVID. So I'm referring to London and the southeast of England.
Perfect. And we'll leave it there. Thank you, Alessandro, and thank you, Rachel. And thank you all for joining us. If you have any questions on the topics we discussed here, please send an email to the address on the screen.